All right, we are going to start our third and last session for the day. I'm Edward Harrison. I'm going to be the moderator, and I'll just get right to it. We have 4 presentations. We'll start with the U.S. economy and then move for the first time to a more global discussion after that. So let me start with Giuliano Yajima from the Levy Institute, who's going to talk to us about perspectives on the U.S. economy.
All right. So welcome back. I'm truly sorry. I mean that you have, it's the last session. So I guess most of you are, either tired or just want to go jump straight to the dinner. But I have to still annoy you a little bit, with some U.S. facts. But I mean, I'll try to be brief on that. And also because, either Randy and obviously the other presenter were, kind of touch a lot of the points that I want to touch in this presentation. But yeah, I mean, little bit of sort of the outline of this presentation. So I mean, I'm gonna talk mostly, on this, mostly of the drivers of the U.S. growth, after the COVID recession, and in particular, and then I'm gonna focus a little bit on the determinants of the U.S. Current account deficit, and also on the potential impact of tariffs. And also sort of raise a little bit of, points to, to further enhance the discussion. So the first thing I want to sort of point out is the fact that so obviously, you had this, if you notice the trend of the recovery for, GDP, for the US and other, trading partner, you see that, basically, sort of the Western world, I mean, mostly US and Euro, and the Euro area has lagged behind with respect to the, impressive recovery that, China has experienced, from the quarters after the COVID shock. And you see, if you instead look at the trend of the consumer price index in this 3 area, you instead immediately notice the difference, and the difference being as of China being obviously getting a little bit of a little bit of push in terms of inflation, but managing overall to contain the main manage to contain it with respect the US and the Euro area. This obviously points out, obviously, what we all know in this room, the fact that there were massive supply side bottlenecks arising, in the US and the EU. And it also points out to an interesting trend because, we will expect also the Euro area to have a little bit more sort of effect and eventually overcome sort of the US, also, especially after in the aftermath of the the beginning of the second stage of the Russian-Ukraine conflict. Well, you still see that US has kind of in terms of CPI still still overcome the EU area in this respect. And obviously you have a combination of accelerating growth and and also rising prices. What you experience in also in the to a larger extent in the US, it's the real exchange rate jumping, and then in an appreciation trend. And you kind of see the same, a similar trend, especially essentially again with the the Ukrainian shock, with with the increase in for the real exchange rate for the Euro area. Whereas if you look at China, exactly the opposite trend. So exchange rate coming down. And as a result, you take it from basic macro 101. You have resulting this buildup of this imbalances from the current account side, and especially the deterioration of the already deficit position of the current account for the US. and this kind of stop and go sort of trend for the current account balance of the euro area. As for the drivers of the U.S. growth, well, I mean, again, here you see. Here you really see that the main sort of driver of this growth in terms of aggregate demand has been investment. So investment has jumped pretty much more than the other component of aggregate demand, and investment has been driven mostly by software, or to be more precise, to follow the categorization of the NIPA, by intellectual investment in fixed investment in intellectual property products. That also contains software and also high-tech sort of high-tech products, and this is actually arriving in terms of value to overcome sort of the investment in the equipment, and definitely has more than sort of more than overcome the other investment, the residential investment, which has been kind of important things in previous cycles, and also all the investment in structures. And as I did say that, I mean, I could kind of here I'm kind of overlapping with the presentation of Randy, but here you clearly see if you take this sort of Minsky and sort of Godley, definitely Levy approach of the sectoral balances, you see that it's the You see an interesting pattern. So the pattern is that basically, well, I mean, it's what you don't see actually is that you don't see the sort of the private sector balance, that is the net acquisition of financial assets, that is the net savings for the private sector as a whole. You don't see going into sort of in a prolonged period of sort of negative in a negative position, which is something that instead happened before the great financial crisis. So I mean, it's in other words, so that's the private sector as a whole is a net saver. So in this sense, is not there are from a sort of a macro sort of sectoral balance approach, there are no sort of huge risk building up in this in the private sector. And then if you look at the sort of the more sort of the balance sheet of the sort of the private sector, you see that those sort of the debt to income ratio, even if you take sort of instead the debt of the non-financial corporate sector, or either sort of the short-term loans for household or the mortgages, you see that our whole seems to have reached a plateau. I mean, in the at least from starting from the 10s, sort of the aftermath of the great financial crisis. That is not to say that those sort of tendencies, that those levels are relatively high with respect, say, the 90s. In fact, I mean, the figure here is cut to the the most recent periods. But even if you were to extend it to to incorporate Goldilocks, and then even before even the 80s, you'll see that there is a plateau, but this plateau has it's kind of has risen in the recent 4 decades with respect the 80s and the 70s. And then, for the sort of the third part of the presentation, the more sort of tariff things, this is something that actually, so this picture actually, this figure actually is very interesting because here we plotted the figure for the famous formula proposed during Liberation Day, well, in the aftermath of Liberation Day, actually, by President Trump. So, long story short, this is the sort of formula that has been devised by the USTR to sort of justify the imposition of retaliatory tariffs. So here, basically, I'm taking the trade deficit here of the U.S. against over the value of imports, which, if you recall, it is sort of, there was the basic formulation proposed by the administration to impose certain. It's the formula that for which he devised this table that he presented on Liberation Day, and then it was later published in this in the web page of the USTR. So what is interesting about this figure, it's particularly the red segment. Because here, I mean, you can think of this approach of, measuring how much do we have to increase, our tariff based on the size of the trade deficit as a kind of a gap approach. What do I mean by gap approach? By a gap approach, I mean, so given the fact that we have a gap in trade, so basically we will impose a tariff that, will cover up this the gap that has been built up for a number of reasons. So whenever this figure tends to increase or bends to your right, exactly. So it means that this gap is increasing. So for whatever reason, we are either our partner or ourselves, we are not good, or ourselves as American, we are not good, as the United States, we are not doing great in terms of trade. So we have to impose a tariff in order to to reduce this gap, right? Or to close this gap. So the fact that during the first administration of the first Trump administration, this gap increased in a period in which we know that instead the tariffs were raised in the nominal rates of for tariffs just against China, but they were nonetheless raised with respect the previous period. Well, that kind of tells you something regarding the effectiveness of this tool, because if you're saying, okay, the tariffs actually works, but then effectively during this period you increase the gap measured by this formula actually increase, then perhaps they're not doing any good, or perhaps they're just doing as bad as other policy in terms of increasing the trade deficit. So, and that's that's an interesting figure that we produce in our latest sort of policy note, and and then there is another interesting, and then if we actually notice if we actually take the actual figures for the tariff rate, and here we simply crunch the data from from the custom agency, and then we basically produce what that's the usual, the most consensual measure of ex post tariff that you can use. That is the value of the custom duties over the value of or the value of imports net of the duty, the net of the value of the duty itself. Then here you notice obviously the pattern, a completely different pattern. So here, for the set of figure, you have basically the tariff rate on the horizontal axis, and on the vertical axis you have instead the import penetration rate. That is the value of imports over the value of GDP. And you see that even when when there was when those tariffs were imposed against China, you see little, if not you see some effect in terms of reducing the import penetration, but you don't see basically the level of tariff return to the pre-80, so 90, 80 or 90 sort of era. But but the level of the level of imports basically stayed the same. With little, they flicked a little bit. I mean, in terms of they increased by 50 basis points or something. But with this rate spiking from 300 to 100%, you would have expect perhaps would have expect more reaction. And then what other countries are experiencing is instead an increase in their demand for their products. So in this instance, you you see both Mexico and the EU, you are having instead an increase in the import penetration from both of these two countries. And if you we crunch, again, in this policy note, we crunch a little bit the data, and then we focus also on the certain specific categories in terms of, in terms of the export of goods. And then here, what we have noticed is that basically, if we're to take the core manufacturing product, that is material manufacturing and machinery and transport equipment, here we notice, either an increase of, custom duties and an increase of, of the import penetration for these products. And really, the only effect being reducing a little bit of demand from China. But I mean, there is another interesting fact that that's basically that is not it's not really mentioned in the public debate and in generally also sort of the economic debate. That is the importance of the foreign content of exports. So the foreign content of export, I mean, to give you the definition, are those exports that are commonly known as re-exportation. That is, goods that are previously imported and sold abroad without U.S. transformation. That is, goods that are labeled as U.S. goods, but have not been produced in the U.S. soil. And those goods represent these days, for core manufacturing exported product, around 25% of the total of export of these goods. And the re-exportation share has been increasing continuously since the beginning of the 90s. And and in particular, and has been increasing also during the first round of tariffs. So now, from and in the last two administrations. And in particular, I mean, it's if you take, for instance, a country very, very peculiar in terms of its integration, in terms of value chain with the US, such as Mexico. So those core export products now are, so the share of re-export of these core products now totals 40%. So, which is sort of a huge number if you think of if you think in terms of if you're thinking about reshaping your value chain. So there is also another number which is not here actually. So it is related to the intra-firm trade. That is, the trade that is carried out among firms that have some relationship between, say, country A and country B. Country A obviously is US, and country B could be whatever country, it's whatever country you can think of in terms of relationship with US. So this related party trade constitute at least 43% of total trade of 43% of US trade. And obviously the top countries that engage in this kind of intra-firm trades are obviously the usual suspect, that is Canada, Mexico, China, and Germany. So and if you add up this with the importance of the growing importance of the share of export products that are not produced in the US, well, you kind of starting to get an idea of how integrated within the trade system this country has become. So, little bit of food of thoughts also for the next panel and for the next panelists, and then I'll thank you for your attention, and I'm done.
Just check it. Can you hear me okay? All right, great. Let me see. Sorry, do I just push the... Oh, there we go. Okay, All right, hopefully that doesn't count against my time. All right, well, thank you so much. Thank you, Pavlina and the team, to invite me here. It's an honor and join this distinguished panel. So I'm going to switch gear a little bit, even though I do have a lot to say about the US-China trade disputes. But my focus today is on how China does it, how China mobilizes domestic finance, and to keep the foreign capital at bay. I think if we do see China as a strategic rivalry, we need to understand them, right? We need to understand how they're able to really implement. I think one of the questions from the earlier panel is about economic democracy, right? China is able to mobilize resources towards that public cause, towards that common goal. And so here is just a small glimpse in 15 minutes about how China does it. So what I would go through, first of all, very quickly, is some sort of theoretical approach to how countries can harness development finance, and second is how China does it. So I have this very cliche title about development finance with the Chinese characteristics, especially when it comes to how it mobilizes domestic financial resources, and also has a very calibrated approach to integrate into the global financial system. Oops, sorry. Wow, I guess we don't really care about the mainstream approach too much, do we? How do I go back? All right, anyway, so the mainstream approach, is there a way to go back, actually? Here we go. Oh, magic. Okay, all right, so the mainstream view, as we know, is this idea that we need to rely on the private capital. Private capital is sizable, they're efficient, and they're self-regulated. So we hear the story that is being floated today, right? This idea from billions, which is what the government can afford, to trillions, which is the private markets are able to put on the table, right? This is the Glasgow alliances to net zero, basically saying we're going to mobilize $100 trillion in the next 10 years to fight the climate change. And of course, now many of them already exited the alliances. This idea that financial markets know how to allocate resources, and financial markets are self-regulated. And for developing countries, right, what they need to do is to attract foreign capital. How do they do that? Liberalize, right? Liberalize the financial markets. And that would help to bring foreign capital to fill their saving gaps and also their foreign exchange gap. So the way to do it is, yeah, you need to have sound so-called macroeconomic policies, fiscal discipline, right? And you need to have healthy financial institutions, macroprudential policies, and correct sequencing, and so on and so forth. So we need to manage the risks, but liberalization, right, is the fundamental solution to this. Well, the MMT view backs the difference, right? What the MMTers have been talking about, the post-Keynesians as well, is that we start with credit/financing, and this helps to finance investment generate income can be saved. So savings cannot take precedence, right, before investment can take place, before finance and credit can be extended. So I wrote early in 2012, looking at China's development finance institutions, what I wrote is that you need to have the finance first. So how do we have the domestic finance? Studart, his wonderful books in 1995 talked about in development finance literature, right, that he examines, the role of the banks is to supply finance, and savings and financial markets then provide the funding. You can't get this backwards, right? How do we get the financing? It can be created at both levels. At the state level, government spends the money into existence. State budget is able to finance all these public investments and so on. Private banking level, the private sector borrows the money into existence. So we know that's how it can be done. What about attracting foreign savings? Well, first of all, it is unsound. This is, I think, Young Kragel's great contribution to talk about if you need to keep borrowing new loans, right, at the rate that's greater than the interest that you have to pay on the old loans, you essentially are engaging in a Ponzi finance, right? And it is not feasible. Why? Well, the data shows what the mainstream also has acknowledged, so-called Lucas paradox, right? The financial resources actually does not go from developed countries to developing countries. The reverse is true. What we see is a net financial resources transfer from the developing south to developing north. And so this chart here shows very clearly that in the great parts of 2000s, we have net resources transfer, and then that happened again in 2021, 2022, and 2023. So this idea that we can simply attract foreign capital simply does not work. Now, there are only two ways a Ponzi scheme can end. One is the bad way, right? So you keep trying to convince the next fool to refinance until the music stops. And what happened is then the debtor countries would have to either default or they would have to come up with the resources to pay for the creditors, whereas the creditors, they're left unscratched, even though they're also responsible to a great, a share for this kinds of extensive reckless lending. And the good way to end the Ponzi finance is what Ren Kriegel talked about. We need to build our real capital and progressively reduce the need to finance externally, right, to support our net imports. So we need to create domestic finance to mobilize domestic resources. So again, Stuart talked about banks do not intermediate. They provide credit from the thin air, right? And this great institutionalist, J.F. Foster, also talked about whatever is technological possible is financially feasible. And to the perpetual question, where's the money coming from? The answer is always the treasury of the sovereign government and commercial banks, right? So I think that is enough to say from a theoretical perspective. Now, the way China does it, I think exactly stick to the second view, which is we wanted to have a credit-led investment-driven growth. And so the top panel here shows China's growth rate. In the past 40 plus years, the average growth rate was 8.9%. And even now, China surpassed that middle income level, right, income per capita. And on the way to the higher income level, it is still targeted at 5% growth. Right? In history, only a few countries could do that, countries like Singapore, right? And so as you see from the top panel, investment is still accounting for about 41% of GDP. Now, the world average is about 26%. For developing countries, slightly higher, but still, China is quite exceptional, right, in pulling the resources into the kinds of investment. And the bottom chart here simply shows how capital formation has driven growth. So a lot of these misconception, right? It's about China export its way to growth. It's actually a myth, right? China relied on export-led growth probably in the brief time period between 2001 and 2008. But before that and after that, China most relied on internal demand-driven growth. Now, how does China finance the kinds of investment? Well, pretty much commercial credits. Commercial banks, commercial loans account for about 77% of corporate investment, okay? So the top chart here shows the growth of commercial loans, that's the solid line, and the dotted line is the fixed asset investments. So you can see how they work in tandem, even though there are some amplification of one than the other. And the bottom here, what is interesting is you see that since 2010, which is pretty much when Xi Jinping took power in 2012, China has seen a very large, fast growth in the state budget in financing investment, okay? So the rate of growth annually is 14.7% for state budget, and domestic loan is only 4.6%. And as you can see, foreign direct investment is actually a negative contribution to that, okay? So again, there's no such a, I think that, again, is a myth, right? That China somehow is able to attract foreign investors and therefore they're able to grow, and that is pretty much, I think, not the reality if you look at the data. I know I put a lot of graphs here, but I think the first one that you notice is really China's credit deepening, right, compared to other countries in the world. When you look at China's credit to I think this is for, what is it? Sorry, I can't read it from here. But this is a credit to non-financial sector, right? So again, China stands out at 886% compared to the emerging markets average of 221%. And a lot of these banking loans, right, are controlled by the state-owned commercial banks. So the state-owned commercial banks, the so-called Big Four, account for over 40% of the total banking assets. Then you look at the right chart on the top, this is private versus public investment. So what you see here is public investment takes up about half of the total investment in China, okay? So the government-led growth, government-led investment is the mainstay of that investment horizon. The next thing you see on the bottom on the left is where does the investment go? Infrastructure, industry sector, and before 2021 in the real estate sector. And then things happen in 2020. The Chinese government decided the real estate sector is too much speculation. We need to cut that off. You see the grand pivot, which is the right on the bottom, that chart. So what you see is the state-owned commercial banks not only control in terms of how much credit they give, right, to support investment, but also really direct the credit flows to the sector they wanted to support. So what you see here is that the loans goes to the real estate sector precipitated, whereas the loans that go to the industrial sector has really taken a sharp increase. So that is a grand pivot to move resources from the speculative real estate sector to the industrial sector. Now, in addition to the state-owned commercial loans, we're also seeing the government open the public purse string to support industrial policies. So this is a study that drew upon the DC's, the Center for Strategic and I can't remember, one of the think tank, that basically lamented on China spends so much on industrial policy, which is true, right? So we're seeing that here the government provides not only the below market credits and land uses and so on and so forth, that it's in the China-specific factors, but you're also seeing the government direct support for R&D, the R&D tax incentives, other tax incentives, and then direct subsidies. So China spends 1.73% of GDP to support its industrial policies. And not only that, the government has also initiated, since 2015, the so-called government-guided funds. So this is supposed to be a public-private joint kind of efforts, where the government is going to put up these investment funds, where the private capital can join. And by late 2020, about $1.45 trillion worth of the government-guided funds were set up. And they will mostly funnel resources to the so-called national strategic emerging industries. The most famous one is the so-called Big Fund, which is to support the semiconductor chips industry. Then you also have all these sovereign wealth funds that have been investing in various industries. So some of the examples that I gave here is the China Investment Corporation that has invested heavily billions of dollars in tech industries, financial industries, and energy industries, as well as banking sectors. Then the Central Huijin Investment, this is another sovereign wealth fund that has invested $722 million in just last year, within 1 year, between 2023 and 2024, in the big four commercial banks. So then the most recent initiative is the so-called National Venture Capital Fund that was set up back in March this year. And the government, again, is allocating 1 trillion yuan funds, which is about $138 billion, to support AI and other technologies. So all of these, again, is another tool, right? The government is setting up all these guided funds with their own state budgets, right, to support these industrial and emerging technologies. So this is, again, as I think Randy said, we cannot leave Levy without seeing some sectoral balances. So here is the China one. So what you're basically seeing is the dark column that is representing the private sector's surplus. And I flipped the sign of the government, the trade deficit to show that, the trade surplus, to see the mirror effect. So basically, China's external surplus and the government deficit have allowed the private sector to save, to generate surplus, okay? In the meantime, as I mentioned earlier, China is also very surgical in controlling its capital account. Foreign capital is welcome only if it contributes to whatever the government wants them to do, right? Which is to support productive investment. So in this case, FDI, the foreign direct investment, is welcomed. There are ways to attract FDI through, for example, preferential tax rates, but there are also restrictions. There is the positive list, which turned the so-called negative list in 2018, which is basically show the sectors where the foreign capital cannot enter. So they recently just fully liberalized the manufacturing sector, but they're still keeping restrictions on the service sector, okay? I did my PhD dissertation about China's FDI, and there are all these, guidance and also restrictions, regulations, investments to make sure that China is taking advantage of the FDI really use FDI for its own advantages, right, as opposed to just welcome FDI with no conditions attached. China also regulates overseas direct investment, especially in terms of the sectors. And I think now they're, again, encouraging more private enterprises to invest abroad, especially build supply chains as part of the result of the US's trade war and tariff war. So especially Global South, right, they're likely to see more Chinese investment as opposed to Chinese official lending, I would say, in the next 10 years of the BRI second stage. In terms of portfolio inflows, the government is taking a very tight grip in managing the portfolio flows. So they have done a so-called staggered strategy. So they gradually, very carefully loosening the controls of the portfolio investments. So they have the so-called qualified foreign institutional investors that was introduced in 2002. So foreign investors need to meet certain criteria in terms of their asset under management and various credentials to be able to invest in China, and they have to do this through approval, registration processes, and so on and so forth. And then the RMB QFII basically was introduced in 2011. The difference is these institutions are able to use the offshore RMB that they have to invest in China. In terms of stock and bonds, again, foreign investors cannot directly invest in the onshore markets. They can through the so-called connects from Hong Kong. So again, very surgical, very careful management in terms of the portfolio inflows as well as the outflows. Similar approach, the QDII and then the recent pilot program is the Qualified Domestic Limited Partnership. I have a chart here just to show that, again, is very much managed in terms of what they can be investing in, what kind of assets size they need to have, how much they can invest in one single entity. For example, one QFII cannot exceed 10% of the equity share. And for one entity, you cannot have more than 30% of your equity share held by the QFII. So there's a lot of management, a lot of regulations behind this. So how effective is this? I think many people argue, with this footless, right, financial capital, you can't really control it well. Well, again, China's experience is just different. Right? When you look at, for example, the foreign investors, they only control 2% of China's stocks and 4% of the bonds. Compared to the United States, I think China's current capital control seems to be quite effective. And China has only, 53% of the GDP worth of external assets and its liability. So again, of course, this is a positive net international investment position. The United States is $22.5 billion of net liability. So will China continuously liberalize? Possibly, right? But again, they're not going to do it as a sort of shock therapy. They do want to promote RMB internationalization. They want RMB to be used more in cross-border trade and investment and payment system. But again, they're going to do it balancing the positives and the negatives, and they're going to do it in a managed way. This is just, I think this is probably one of the last slides. I got about a minute left. So the top one shows the portfolio investment flows versus the FDI. So again, it's not until very recently when China deregulates some of the financial investments that you see a surge. And that is largely, I would argue, due to some of the hot money flows in anticipation of the currency fluctuations. And then the bottom here shows the China's external debt, right? That is about 14% of the GNI, the national gross national income, and debt service is only 10% of the total export revenues, which is a lot less, right, than the most conservative recommendation by the IMF, which is 30% and 14% respectively. So this is just to compare China's international investment position with other countries. So again, China is very limited in terms of its international sort of integration, right, when it comes to financial sector, not trade, but in financial system. My final word here is, again, I think we cannot leave Levy without a set of balance, but we cannot leave here without Minskyan quote either, right? So what I wanted to show here is, as Minskyan wrote, while the market mechanism is good enough device for making social decisions about important matters such as the mix of colors in the production of frocks, that is unimportant matters, such as the production of frocks, the length of skirts, or the flavor of ice cream. No, my kids would say this is super, super socially important matters. It cannot and should not be relied upon for important big matters such as the distribution of income, the maintenance of economic stability, the capital development of the economy, and the education and training of the young. So I think MMT offers invaluable insights on development finance, and you need to preserve the monetary sovereignty. I know my colleague's going to talk about it. I didn't have the time to go through it. But again, use the public money for public cause. So I'll end here. Thank you so much.
Okay, that was very interesting. Now we have Ndongo, Samba, Sylla, who is from the International Development Economic Associates, and he's going to talk to us about the critical thinking about monetary sovereignty.
Let me check my slides. Okay. So I'm really pleased to be here. So I would like to thank the Levy Institute for its invitation, and especially Professor Pavlina. So my presentation is about critically thinking about monetary sovereignty and balance of payment constraints in Africa. According to critics, most countries could not enjoy monetary sovereignty in a modern monetary sense due to, quote, the implications of the external constraint as developed by several authors, including Anthony Sylla, that is, the limitations that a country faces in its economic growth and development due to its reliance on foreign currency or foreign resources to support its balance of payments. So basically, there would be a great wall between modern monetary and the global South monetary sovereignty. And that great wall is called the Sylla law. In fact, there have been many precedents to the Sylla law. I mean, Roy Arott, Nicolas Caldor, Raoul Prebisch, etc. The idea behind the Sylla law is that as countries developed, they are reliant on imports of raw materials, of equipments to spur their industrial development. But as it is assumed that exports are the safest way to finance imports, in fact, countries that do not manage to have enough foreign earnings might see a constraint on their economic growth. That is basically the idea behind the Sylla law. So the Sylla law predicts the long-run so-called sustainable rate of economic growth consistent with a balance of payment equilibrium. So starting from a position of balanced rate, the long-run economic growth is said to be equal to the ratio between the real growth of exports and the income elasticity of imports. Originally, the models assumed that exports are the only source for financing imports and that the terms of trade changes and real exchange rate movements are not significant over the long run. As Anthony Sylla argued in a paper in 2012, he said, I remain convinced that foreign exchange is a major constraint on the growth performance of many poor countries, and that with improved export performance and a lower income elasticity of demand for imports, they will grow faster. But there have been critics, from the heterodox camp of this theory of economic growth. A very interesting critique came from an economist, Antonella Palombo, and she noted the poor fit of Sylla's law with actual data for the majority of developing countries. She made 3 additional claims. First, no conclusive proof is available of the empirical validity of Sylla's law, while there appear to be strong theoretical grounds for denying that it can provide a sufficiently general theory of output determination. Second, it is doubtful, according to her, that the external constraint can be effectively represented in terms of imports-export equality. Third criticism, the notion of external constraint is neither sufficient to identify the long-period rate of growth of the system in general circumstances, nor susceptible of general quantitative representation. To summarize her critiques, she said, far from simply highlighting the role of a particular force, the balance of payment constraint literature amounts to playing down or neglecting all the others, both by assuming that the influence of output on the balance of trade is so predominant in the long period as to allow all other possible influences to be wholly ruled out, and by assuming that equality between exports and imports is the general determinant of the long period level of output, with little attention being paid to possible insufficiencies of domestic demand. So this is a very problematic theory. It's a post-Keynesian theory, yet it doesn't acknowledge really domestic demand constraints. But my own argument here is that the balance of payment growth constraint approach is of very limited relevance as the general theory of economic development. There have been other critics of this approach, namely, for example, by Bill Mitchell, an MMT economist, in the Elgar Companion to MMT 2024. But the first thing I would like to say is that this balance of payment constraint growth literature can only apply to the post-colonial period and not before, because during colonial times, most of the countries were not politically sovereign. And in fact, all these colonies used to have high trade surpluses because they were exporting a lot and they did not import as much. What they imported was goods coming from their metropole. And generally, there has been a technical concept, unregulated exports. That means they have been accumulating foreign exchange they would not using for their economic development. And until 1971, we could say that most the hegemons we have, global hegemons we have, did not have sovereign currencies in an MMT sense. For example, under the international gold standard, Britain did not have a sovereign currency in an MMT sense, and that's why the adjustment had to be made, using the colonies. So this theory could not apply, to the colonial period. In theory, it could only apply to countries with peripheral currencies and that experience chronic external deficits. For countries that issue the dominant key fiat currencies, or for countries that usually record external surpluses, the theory for me is not relevant at all. And yet, even among chronically deficit countries, one might distinguish two groups. First, you have the group of countries that are heavily resource poor. For me, countries that are economically non-viable and that must be either part of a more viable economic set, for example, political federation with other countries, or be receiving unilateral transfers on a quasi-free basis. For this group of countries, for me, we could not talk of foreign exchange shortage. The apparent foreign exchange shortage, for me, is a basic manifestation of several real resource constraints. The second group among the deficit countries, chronically deficit countries, are those that could improve their external accounts if they had a better control over their natural resources and their financial systems. For these countries, the so-called foreign exchange shortage, for me, reveals often a lack of fiscal and technical control over their exportable resources and their external trade in general, as well as a questionable distribution and allocation of their export earnings. Here, I would like to take the case of Zambia. Is Zambia foreign constrained? Zambia is an African country producing copper. Between 1980 and 2023, a period of 44 years, Zambia recorded only 13 episodes of current account surplus. Based on this kind of evidence, most economists, mainstream as well as heterodox, would assume that Zambia is foreign exchange constrained. Yet Zambia is a vivid illustration of the superficiality of such an observation. The reality is that most resource-rich African countries have limited fiscal and technical control over their natural resources. As a result, most of the recorded export income in the balance of payments hardly accrues to them. On November 2020, Zambia defaulted on a coupon payment of 42.5 million euros on a 1 billion euro bonds. But in its 2023 report, the International Monetary Fund wrote, Zambia's balance of payment has historically been characterized by large leakage in the form of sizable private sector assets held abroad. These outflows average 1/3 of copper exports over the last 5 years and have been as high as 20% of GDP in 2012 and 2014. So the GDP of Zambia in 2014 was $28 billion. The IMF said these outflows have largely offset the significant foreign direct investment inflows of the early 2010s and contributed to the gradual depletion of reserves between the 2021 SDR allocation. The IMF report added that 50 to 90% of copper exports in 2020 and 2021 were not repatriated, And that understanding how these proceeds were used is key to complementing the assessment of the possible data gaps. So these countries do not have a control over their foreign exchange reserve. These foreign exchange reserves are controlled by the transnational companies that operate their natural resources. And according to the UNCTAD, United Nations Conference on Trade of Development, Zambia lost $12.5 billion US only between 2013 and 2015 in terms of illicit financial flows. That means real resource theft, pure plunder. Here you have another illustration with Equatorial Guinea, an oil-producing African country. You could see in this graph two indicators. In blue, you have the net income payments to abroad. By income payments, it's the returns on foreign investment. The income you transfer minus the income you receive. Here I gave the balance using a reverse sign. Because in the case of Equatorial Guinea, the balance is negative, so net income payments. So Equatorial Guinea is transferring net income to the rest of the world. That means the net profit and dividend repatriations. You could see the external balance in orange, and whenever the net income payments are over the external balance, that means that this country is in a situation of current account deficit. So this country used to record important trade surpluses, but these trade surpluses are generally absorbed, dissipated by the repatriations of profit and dividend. Here you have a numerical example from 2010. The current account balance, as a reminder, is composed of three subcomponents: the balance of goods and services, the balance, the primary income balance, that means the returns on foreign direct investment and on debt, foreign debt, and you have the secondary income balance, which is about unilateral transfers, development aid, and migrant remittances. And you could see that in 2010, Equatorial Guinea exported something like 69.3% of its GDP and achieved a balance of goods and services of 12.5. Yet, this country recorded a current account balance. Why? Because there was a huge deficit in primary income balance. And basically, the deficit is just the profit and dividend repatriations by the oil company. For me, all these countries are not foreign exchange constrained. The thing is that they have not developed the capability to operate themselves, their own resources. And when they also have companies operating these resources, they have not been able to tax them in a way that help them, retain most of the foreign exchange for their own needs. Another example, it's about the debt, because in the past there used to be what is called economic hitmen, people hired by Wall Street to give loans to the third world, loans that they know could not be reimbursed because it would be invested in luxury products, etc. There is a book called The Confession of an Economic Hitman. You could have many examples there. Some leaders that did not like, to take these loans, sometimes we have seen their plan crushed. There are many examples of that in that book. But now you need not have this kind of coercive methods, because the African countries themselves would issue bonds in domestic currency, in foreign currency on international capital markets. But the problem is when you take foreign loans and you invest them in projects that did not generate the hard currency, sooner or later, you will be in a position of, very difficult position, because the debt services, the foreign debt service will become bigger, as well as the debt stock, the foreign debt stock. Here, for example, you could see in the case of Senegal, in 2012, the public external debt service, that means the principal plus interest payments, divided by the export income and the primary income, was 5.4%. 8 years later, it was 14.5%. In terms of debt stock, it was 169, and it increased the 8 years to more than 400. And these dynamics are not sustainable, because these countries have been taking debt in foreign currency to invest that, in infrastructures that might be useful. Often that is not the case, but this infrastructure will only deliver domestic currency, not hard currency. So sooner or later, this country will be in a debt distress. And all these countries, Ghana, Ethiopia, Kenya, Zambia, already defaulted on their debt. Senegal has not defaulted yet, but surely its debt will be restructured. So when you make these kind of policy choices, some people will say, oh, this is evidence of foreign exchange constraint. I would not say so, because countries, must take the right, policy choices, knowing that when you borrow in foreign currency, the only way to make it sustainable is that this debt should deliver foreign currency. So this was a bit the first part to say that, in fact, the notion of balance of payment constraint is generally not clear, because you have to take into account the resource potential of countries and also the policy choices they make. And in terms of development theory, in fact, most of the important theories of economic development acknowledge that you could have kind of external constraint, but those are not the most relevant constraint for economic development. And I would like to give some examples based on some the work of some theoreticians we know. But before that, there are also some critical assumptions, implicit assumptions by the balance of payment constraint growth literature. Often, there is an assumption that the global south will remain technologically dependent and will rely on, models of development that will, continue this technological dependence. So that means there is no room for economic planning that takes into account foreign resource constraint and also significant domestic innovations that lessens technological dependency. The current internal payment system also will remain the norm, because now there is a possibility for countries to trade using their own currencies, and this will give them, more policy space. But this is not generally acknowledged by this literature. And last but not least, this system also, this literature also does not investigate whether capitalism can, create the conditions for economic development for all the countries. Many thinkers in the South, like Samir Amin Furtado, used to think that capitalism is inherently a polarizing system and that it could not deliver economic development for all the countries. But I will not talk about these points, but just the first one quickly. As I said, most of the important theories of economic development acknowledge that you could have some external constraints. But those are not the most relevant constraints. Kalecki, for example, in his classical paper on the problem of financing economic development, wrote that the process of development tends to strain the balance of payments by raising. Oops.
It's displaying.
Okay.
It's just a monitor. It's not working.
How can I go back?
The red button.
Red button, okay. Oh, yeah. So Kalecki acknowledged that developing countries in their process of economic development could have some difficulties regarding the balance of payments, but at the same time, he acknowledged the difficulty of securing import of capital from developed to undeveloped countries on acceptable terms. And that's why he advocated some measures like land reform, the squeezing of the ranchers, and measures aiming at preventing the export of capital from underdeveloped to developing countries, which is by no means negligible, as we saw. So he was meaning fighting trade misinvoicing, curbing huge profit dividend repatriations, improving the term of trade through industrial policy. He also noted that for long-run economic development, you need innovations and also to squeeze the ranches. So I'll go quickly. The same thing also could be said about Schumpeter. And Schumpeter has a very interesting theory of economic development, because he was saying that development is not about equilibrium. It's about innovation, and that means employing existing resources in a different way, in doing things with them, irrespective of whether those resources increase or not. And you could also see that the same point was made by Minsky in his discussion of Schumpeter, because Schumpeter was rather upbeat about entrepreneur banker nexus, but Minsky was making the point that if you don't have the adequate financial structure, you could have patterns of explosive growth and explosive business cycles. And to that extent, you needed to have banking and financial structure that are conducive to economic development. For example, in the case of raw material export economies, Minsky noted that they were typically characterized by banking structures that specialize in commercial credit, and he said that such banking structures are ill-suited for financing the capital development of their economy. And this type of point also has been elaborated in detail by authors like Samir Amin, who noted that the banking system in developing countries have been one critical factor explaining their underdevelopment. So I will maybe go to the conclusion. I had other slides, but just to say that what the heterodox economic literature often posits as external constraints is reflective, to my view, of constraints arising at another level: real resource constraints, domestic constraints, policy and political constraints. So as long as one has not investigated together factors such as countries' real resource potential, material domestic technological possibilities, domestic monetary financial constraints, international payment possibilities, policy and class constraints, one cannot assume that foreign exchange shortage is the major constraint factor for economic development. And to the extent that external constraints, often taken for synonymous with foreign exchange constraints, are not carefully unpacked, there is the risk of falling into the trap of crude empiricism, as most MMT critics do. And I would conclude by saying that if the foreign exchange shortage was the ultimate or the most important constraint faced by peripheral countries, well, they would be probably in a far better shape than they currently are. Thank you.
Okay, and to round out the day, we have Fadhel Kaboub, who is from Denison University. He's going to talk about the Global South in general.
Thank you. Well, I'm the one standing between you and the reception now, officially. I don't have a PowerPoint, but I will talk about power, and I do have a few points to make. So, before we start talking about the standard issues that are often raised when people talk about industrial policies and how do we finance industrial policies in the Global South, before we blend the finance, before we KPI your entire life, before you de-risk the projects, let's get to the structural issues so that we know what we're trying to do. And when it comes to Africa in particular and the rest of the Global South, it's very important to recognize and to understand that there is a particular economic role that was imposed on the African continent during colonial times for colonial purposes, and that particular role persists to this day. And unless we undo that economic function that was imposed on the Global South, we're not going to be successful on the climate front, on the SDGs, on a just transition, or even on democracy. So, three major roles. Number one, Africa was supposed to be the place for cheap raw materials for the industrialized world. We still play that function to this day. Number two, Africa was supposed to be the consumer of industrial output and technologies from the rest of the world, the industrialized world. We still play that function to this day. That has to change. And number three, and most importantly, we're supposed to be the place where obsolete technologies, assembly line manufacturing, that is no longer needed in the industrialized world, is outsourced to the Global South under the label of development, cooperation, job creation, but effectively what it does is that it permanently locks you at the bottom of the hierarchy, at the bottom of the value chain. So those are the three main economic functions, and let's remember that those colonial structures were not designed to deliver development. They were not designed to deliver democracy or SDGs. Colonial systems were abusive, violent, extractive, hierarchical, undemocratic. So why do we today somehow develop this idea that somehow the same economic structures will somehow produce a just transition, somehow will produce development or achieve any of the sustainable development goals? that we set for ourselves. So before we blend the finance and do all of that stuff, let's figure out how do we undo those structures. And we live in a global economic architecture that was designed for that purpose. When I say global economic architecture, it's the financial architecture, that's the World Bank and the IMF. It's the international trade and investment architecture, that's the WTO, essentially. And especially when it comes to the rules related to intellectual property and technology, transfer of technology system. And then you have the international taxation architecture, which for the longest time was in the hands of the OECD countries until very recently, thanks to the UN vote to create a UN tax convention framework, which was very aggressively resisted by OECD countries. And it's still work in progress, but at least it's a step in the right direction, sort of to decolonize that pillar of the economic architecture. Everybody's talking about the financial architecture, but good luck transforming that with the US veto power and the IMF and the World Bank. The blind spot for a lot of these conversations is the WTO. And guess what? The recent trade disruptions that the Trump administration has created is sort of opening a window of opportunity to actually go head-to-head with the WTO rules, but only if the Global South is organized and clear-headed enough to know how do we transform the rules of the WTO. So those are the structural issues you want to start with. Then point number 2, you can count that as point number 1 from my PowerPoint. Point number 2 is this idea that somehow developing countries will industrialize one country at a time. Now, unless you're the size of China or India, you're not going to industrialize alone. Why? Because to industrialize, you have to have economies of scale, which means if you don't have economies of scale, you're going to end up manufacturing a small component in somebody else's industrial policy, right? So we have ministries of industries and ministers of industry who are mandated to develop a national industrial policy, and then you end up doing what? De-risking investment for multinational corporations to attract them to set up factories to produce a small component in somebody else's industrial policy. That's not industrialization. However, if you take regional economic blocks, take the African continent as a block by itself, you have the youngest labor force on the planet, literally. You have all the critical minerals that the rest of the world actually wants, which is the basic input for the 21st century, right? You have the economies of scale on a continental scale. You have the complementarity of resources and capabilities, which is what you need for joint industrial policies. But you're lacking a couple of things. One is political leaders who are clear-headed enough to understand that you actually need joint industrial policies, that nobody's going to industrialize alone. And that's a big problem, which I can get to in a minute. But also you have another problem, which is you don't have the manufacturing technology that allows you to leapfrog in key industries. Because the key industries that you need, especially in the African continent, is not producing batteries for US manufacturers, EV batteries, or for European manufacturers to outcompete the Chinese EV manufacturers. That's not an African priority, right? But unfortunately, there's a lot of incentives from the US now for Zambia, for the DRC, for Tanzania to set up EV battery manufacturing when we're talking about countries that don't even have electricity for their own people, right? But the priority is to produce EV batteries on the cheap to compete with the Chinese EVs. So the priority is the following industries. Number one, to manufacture and deploy the renewable energy infrastructure for the continent, to deliver first to the 650 million people who have no access to electricity as we speak, to manufacture and deploy the clean cooking infrastructure for the 950 million people, mostly women and children, inhaling toxic fumes on a daily basis. That's an industrialization opportunity. To manufacture and deploy the clean, green public transportation infrastructure to build the logistics of development and prosperity. And here we're talking about replicating the entire value chain of these industries. And if you think of just these industries replicating an entire value chain, components of these value chains are actually springboards to many other key industries that will come out of that industrialization. So the manufacturing technology that allows you to leapfrog into this type of industrialization, the technology is available in the global north, is available in China. So why is this technology not part of the discussion when we talk about climate negotiations, for example, in COP, which we do actually bring up from a global south perspective, and you see very clearly that that's a red line. No, we're not here to talk about manufacturing, we're here to talk about emissions. It's like, what do you mean? But this is climate policy. This is how you actually decarbonize the world economy. No, we can talk about that in another conference, not here, not today. Don't talk about that, right? That's not the purpose. And then you realize that it's actually intentional. Here's why. This is where power and geopolitics comes in. If you look at IRENA's report, IRENA is the International Renewable Energy Agency, from 2 years ago on Africa. You can read it straight from the executive summary. Africa by 2040, which is the day after tomorrow, actually, by 2040, with existing renewables technologies, not with new innovations and fancy tech stuff, with existing renewables technology, can produce by 2040 1,000 times its anticipated energy needs from renewables and completely replace all of the continent's fossil fuel exports. 1,000 times. If that's not the economic powerhouse of the 21st century, I don't know what is. Now, match that potential, which is real, with the fact that Africa attracts less than 2% of financing that goes towards renewables, global financing. Actually, the number was updated as of last week. A few days ago, I was at the IRENA conference in Bonn, and they said the number is now 1%, actually, not 2%. So how do you explain that? We're in a climate crisis. We're talking about this massive potential for a continent that can completely change the world when it comes to decarbonizing energy production, and yet it's a continent that's denied access to the financing and denied access to the manufacturing technology that will unleash this potential. And it's very simple. It's because what we perceive as a huge potential, as a win-win for everybody, is actually perceived as a threat to be eliminated, as a risk to be minimized. Because it's as if you took the economic weight, the geopolitical weight of the OPEC countries, the oil exporting countries, multiply that by 1,000. It's perceived as a huge geopolitical disruption to the system, because there's this perception that the world operates as a hierarchy, as a colonial hierarchy, countries at the top and countries at the bottom. If you unleash the potential for Africa and the rest of the global south, which is the global majority, by the way, that's close to 80% of the world population, if you unleash that potential, then you escape the bottom of the hierarchy, you structurally decolonize that economy, and then somebody else must drop at the bottom of the hierarchy, right? There is no real belief in the possibility of actually allowing development and industrialization and decarbonization in a new international economic order that is actually truly multipolar, without anybody dropping at the bottom of the hierarchy. The perception that there might be a win-win scenario, countries at the top of the hierarchy don't actually believe in that. They believe somebody must drop at the bottom of the hierarchy. And that is just not right. So I'll give you, since I do have time, just a little taste of where some of my work in this has been moving. So we understand the geopolitics of this, but it's really kind of frightening when you hear, off-the-record conversations, behind closed-door conversations about this, especially in the climate space. And I'll share this since we're being recorded without naming any particular publication, but a senior editor at a major newspaper that I think all of you read on a daily basis, you probably know which one it is, who's very familiar with these questions, with the issue of transfer of technology to unleash this potential, with real industrialization in the global south. shared with me the content of an off-the-record 3-hour conversation with a senior official in the OECD in charge of industrialization about these questions. And this was November 2023, before COP in Dubai. And he said the gist of those 3 hours is the following. Nobody in the global south is allowed to industrialize without our approval. So the perception is that this is a red line. This is massively disruptive, which is why you go to COP29 last year in Azerbaijan, which was supposed to be the climate finance COP, and you realize at the end of the day, this was not about climate finance. This was not even about climate. This was about the geopolitical hierarchy that is not willing to be disrupted. Because the kind of climate finance we were asking for was transformative climate finance, was actually development finance to unleash this potential. So when you hear those red lines and you see those red lines, you have to start thinking differently. You can't ignore the geopolitical leverage. So the question becomes, how do you create a geopolitical leverage, an economic leverage that will actually compel the other side to think differently, to actually see a potential win-win scenario, to actually give up this obsession with, hierarchies that must persist. So you can go to COP and kind of make the economic case, the financial case, the legal case, the moral case, the ethical case. You get nothing, right? Even though the official speeches, we're all in this together, we're going to figure out climate finance and all of that. You get crumbs at the end, but no transformation. So the question becomes that leverage that needs to be created. I think there's a small window of opportunity, and I only have a minute to say what is worth a little booklet that I'm working on. But I'll give you a taste of it, and I'm here for the next 3 or 4 days, so I'm happy to unpack the rest of it. But picture for a moment having a block of global south countries without China, with predefined joint industrial policies to manufacture and deploy what we just talked about. Imagine we've done our homework and we've designed it in a way that doesn't reproduce the current problems that we have in the global economy or the hierarchies. Imagine that block going to a country like China, which actually has the entire value chain you want to replicate, and saying, look, we give you the bargain of the century. If you agree to share technology as in joint ventures, right? We're not asking for financing, because we pay for our labor with national currencies. We pay for our materials with national currencies. Normally, you need dollars to borrow money to bring the technology, and then you're set up into an export-oriented model where you can actually never develop. But here, imagine it's a transfer of technology, in-kind contribution, to unleash this potential, to manufacture and deploy, say, solar at scale in the global south. In 10 to 15 years, if China agrees to do this, in 10 to 15 years, you can double your economic footprint, you can double your geopolitical weight, secure your access to these precious minerals, and over time, more countries will join the global south bloc because this is real development, which means you have privileged access to the largest market on the planet with rising purchasing power. China will agree to this bargain. Just triggering this process, the idea is not to put China at the top of the hierarchy, of course. Just triggering this process gives you the second bargaining chip, which then you can use to go to Germany and say, look, we give you the same deal if you transfer technology on these terms to manufacture and deploy wind turbine technology. You go to France or Spain, say, high-speed rail on our terms, manufactured here. At that point, they can't say no. And there's plenty of business for everybody, but on terms that are defined by the global majority. The idea is not to allow anybody to go at the top of the hierarchy or anybody to drop at the bottom of the hierarchy, but to create a truly multipolar world with a new international economic order of peace, justice, and sustainable prosperity. Thank you.
So that was a very hopeful note to end things on. Let's kick it off for questions. I'm going to start with a question. I think the most obvious question for me, given what seems like a success story, Jan, from China, is how can that model be replicated or transferred in any possible way to developing countries, the global south?
Oh, okay, it's on. Well, first of all, I think I complete with Fadhel. I think this idea of global hierarchy, I mean, we don't need to hear all these close the door, behind the door conversations. I mean, J.D. Vance clearly declared, right, that globalization worked until China started up the supply chain or the value chain, right? That China wanted to climb up the value chain. And so that basically derailed the entire globalization process. And so I think that would be my question, that would be my response number one, is that define the, deviate from the neoliberal process. You need to manage the economy, you need to utilize your own domestic financial and real resources to really develop your country, right? And so, and of course, I think, China has its unique political system. In China, people say, in the US, you change the parties, but you don't change the policies. In China, we don't change the party, or they don't change the party, but they change policies, right? Whenever there's a need, there's a public demand, they do change policies. I think environment is a very interesting one, right? That China so-called polluted the way, but by 2011 actually, they started this 5-year plan and really hammer out this policy to change climate. And last year they invested $940 billion in green investment, push the GDP by 10%. So I think that is a lesson to be learned, is that you do need to, get your domestic act together, and of course with partnerships and so on and so forth. I think again, developing countries are actually resources rich. And so the question is, can we build institutions, financial institutions, political institutions, social institutions, and economic institutions to be able to really deploy those resources for their own development objectives? I think that, to me, is really the bottom line. It's really the kind of the punchline. But of course, different countries are different, and so they do need to have their own unique kind of approaches. And so in that sense, I don't think China's experience can be completely replicable. And we do have countries, examples where, be it small countries and so on, they're able to grow, right? If you have the smart policies, even the political, the right political will, and have the savvy policies, I do think that is possible.
One question.
I think Jamie disagree.
Ndongo, this is for you. Given there was one part of your slide that I thought was interesting, given the conversation we're having, Senegal in particular, and the debt financing, how quickly the interest costs and the actual debt rose. How much of an impediment is that to what we're talking about here in terms of self-financing, a sustainable model that doesn't depend on foreign investment?
Thanks for this question. Senegal is a very particular country because Senegal is using colonial currency, the CFA franc. And within this framework, in fact, the currency is pegged to the euro. And it's a monetary union, and the monetary union had been in a situation of current account deficits for 6 decades. So as a developing country, how could you have current account deficits and maintain a fixed peg for 6 decades? That's impossible. The only thing you have to do is just to be financially dependent, attract foreign direct investment, but these countries could not attract foreign direct investment. So in order to create their own currency, they have to borrow first euros or US dollar. And that's why when you have a context where there is an opening capital markets, this country will borrow heavily and think that this will create development. But sooner or later, you will have a debt crisis. Because the thing is, you have to meet your real resource constraint. If the resources are not available, you have to be very careful when you issue debt in foreign currency. So if you invest in projects that do not limit some of your imports because you manage to substitute them with domestic production, or if you do not increase your export capacity, you will be in debt distress, and that's the scenario we have been witnessing in Senegal, but also other countries in Africa.
One last question before we open it up. Where capital controls any role for capital controls in this progress for developing countries? Anyone can answer the question. How do you see that as a part of, especially given what we saw in China in terms of its not having an open market?
The short answer is yes, but with a comprehensive set of policies. A lot of people think capital controls and everything else will be great. That's obviously false. But you have to have an industrial policy, agricultural policy, energy policy, in order to use capital controls to protect your internal sovereign economic policy decisions, not to be vulnerable to speculative attacks and such. But to have capital controls and then let everybody else do whatever they want is not going to work. We've seen it.
Okay, let us take some questions. The gentleman way in the back raised his hand.
Thanks very much. This is a terrific panel, but I was especially pleased that Liang brought her account of Chinese financial policy to the Levy Institute, because there's a little piece of history here that needs to be recounted. And that has to do with the fact that from 1993 to 1997, I held the improbably grand position of Chief Technical Advisor for Macroeconomic Reform to the State Planning Commission of the People's Republic of China. And in that capacity, I was able to organize a number of things. It wasn't directly advising the government, but sometimes you got a feel for the direction of conversation. And in 1995, I decided to organize a conference on international economic policy outside of Beijing at Huairu, where the Women's Conference had been, and brought together the Ministry of Finance, the People's Bank, the Planning Commission, and the other academics, the other major players. And I needed heavy hitters, heavier than myself, to convey direct advice to this group. So I reached out to two regular participants at the Levy Economics Institute conferences. One of them was Jane DeRista, my former colleague in the banking committee and a wonderful person, and another equally wonderful person was Robert Eisner of Northwestern University. And I can recount my conversation with Bob because it's been in my mind verbatim for many years. I said, Bob, ever been to China? He said, no. I said, I'll tell you what, I'll get you a business class seat and the United Nations per diem. He said, sounds great. And I said, but there's a catch. He said, what's the catch? I said, you've got to stop them from liberalizing the capital account. Bob came, Jane came, they gave their presentations, and that the rest, as Yan Liang has been telling us, is history. 30 years from the Levy Institute to the Levy Institute, one of the greatest success stories of economic development in human history sandwiched in between. So thanks a lot.
Thanks. Gentleman in the suit in the middle there.
First, thank you for your intervention all. On a more heavy note, I would like to make a comment and then a question. I think, in my personal opinion, that China hasn't the same colonial background as African countries and hasn't suffered the same colonial background. So is it really replicable, this model of development? I'm not sure. My question is, isn't now in this era, China using this colonial hierarchy at its advantage because they're largely investing in African countries, they're trying to cooperate with them, but it is really cooperation, it is really help, or are they taking advantages of this situation for them?
Why don't we start on the end there, because you were talking in particular about how you could work with China. What do you think about the present model of Chinese investment in Africa?
Sure. Every major economic bloc, whether it's China or the EU or the US, has every right to have a vision for itself and to use its economic diplomacy and incentives to nudge everybody to get whatever they want, to get them in position for wherever they see that vision is. And so do we, right, in the global south. Now, the fact that China is doing what a lot of people are describing as debt traps or taking advantage of developing countries, a big part of the blame is to put on the US and Europe, because the only thing China has to do is offer something slightly better than what the US or Europe has done. And all of a sudden, it's much better cooperation, right? That's partly a joke, but also partly reality. The other challenge is on the African side, where you have leaders who actually don't have a vision for what they want, right? And when China comes and says, we have cooperation, interests with your countries, and you see partners who have no vision, well, they say, well, you know what, an airport would be nice. You know what, a new parliament building would be nice. So China will say, sure, we'll do that. But often, China will say, well, we also have economic relations and interests with countries in this region. We have this thing called BRI, which requires building huge infrastructure for having access to minerals, but also huge infrastructure for delivering made in China products over the next 100 years. So you can't blame them for building what they want when the other side is not imagining the world of possibilities that they can actually have with a Chinese partnership. And when the rest of the world is just complaining, why are you going to China? We're here with no money, with just extractivism and neo-colonial, debt traps. So this is how I would summarize it.
If I could just add quickly, first of all, Jamie, I think the 1.4 billion people owe you a big thank you. I was wondering how China evaded the Asian financial crisis just 1 year after your advisory. Now I kind of got the idea. But talking about China's engagement with the global south, I don't know how much time do we have. But yeah, I completely agree. I think, China only accounts for 8% of the extractive industries, mining industries in Africa. So all these idea of resource grab, I think we need to, see with a grain of salt. At the same time, I think all these very fabricated, the so-called debt trap diplomacy has been really debunked many, many times. I mean, in the past 20-some years, China has provided development finance of 1 trillion to, the global south. And of course, at not as concessionary terms as the World Bank finance, but the most recent research has shown that whenever this BRI project has been announced, on average it boosts the recipient countries' growth by 0.8 to 1.4 percentage points 2 years after the announcement of the project. So there's a lot of, I think, productive investment through the Chinese financing, but of course there's the debt problem, and so that's why I think the Global Development Policy Center and others are trying really to get China more on the table when it comes to debt restructuring, which is absolutely necessary, right? 2023, developing countries paid $1.1 trillion in debt services. Last year, $416 billion. And, they're cutting on their investments in human capital, right? Education, in health, just to pay the foreign debtors. And of course, the private bondholders are really the big, creditors of, the global south, including African countries. So I do think that China has more role to play, but I think that this whole idea of debt trap diplomacy is complete a myth. It's very much fabricated with very specific agenda, I would say. Yeah.
Yes, can I have the person in the middle here with the hand raised? Right, right behind the gentleman with the suit.
Thank you. Thanks so much. I have a question for Ndongo. I thought that was, all of y'all, that was really amazing presentation. I learned so much. But this question of the foreign exchange constraint, not actually operating as an exchange constraint, as a foreign exchange constraint, but really real resource constraint, super interesting to me, and I'm curious to see if you would describe the foreign exchange constraint as sort of similar to the deficit myth, which I think a lot of MMTers think about as sort of politically powerful but empirically not valid. And I wonder if you see sort of foreign exchange shortages being mobilized by governments or finance ministries or market participants in order to constrain sort of the political frontiers of development? So that's the question. Thank you all.
Well, I'm not sure whether this is a myth, but it contributes to the adoption of policies that are not good, let's say, for the global south. Because whenever you hear about a lack of something, I mean, you should, be watchful. Because when you talk about the lack of foreign exchange, but lack of foreign exchange do what? Let's take an example. Let us suppose that, Ghana would like to build schools so that all kids could go to school. If Ghana relies on its own creativity, domestic real resources, etc., Ghana does not need any foreign exchange to build those schools. Now, let's suppose that Ghana say, oh, we would like to have US technology or Japanese technology. Maybe in that case, Ghana will have to, obtain, some US dollars, etc., to build those schools. So that means that before talking about foreign exchange constraint, you should first talk about allocative choices. Which technology you use, which real resources you use. And the second thing, as I tried to show in my presentation, is about the distribution of foreign exchange earnings. In the case of Africa, we have a plunder problem. And most of these people talking about debt, they do not talk foreign debt, they do not talk about the plunder problem. My view is that if we address this plunder problem, that means the Africans have a control over their exports, income, their natural resources. Maybe they would not be in a need to issue debt in foreign currency. You take the case of Botswana, which is a small country. Botswana never received a loan from the IMF. So it has a very low foreign debt. Same thing for Algeria. These are not industrialized countries. So that means that if you have a good view of how the monetary and financial system works, you could create prosperity for your country while limiting financial vulnerability and dependency.
Question here. I noticed the first two presenters, Giuliano and Jan, you ended with when God lives sectoral balances. But for China versus the US, right now we're seeing a tension where the US, interestingly, is seeing China as an upstart that is a threat, much in the same way that you were talking about the developed economy being a threat to the OECD. How do you see that current account imbalance or those current account balances reconciling under Trump going forward? Either one of you two, from the US perspective or from the Chinese perspective.
Well, I mean, the U.S.'s current account deficit, I mean, it has been running this, since 1970s. And again, this is a structural issue. It has to do with the dollar's reserve currency status. And that's what Trump is coming up with, this idea of Mark-Logel Accord. Keep the dollar weak, but yet, make sure the dollar is still the king, still the reserve currency. And again, seeing all these trade relationships through a bilateral lens is completely flawed. And seeing it as unfair trade practices, of course, is a folly. So I think that is, unless the kind of structural issues, including the global financial structure and the US's own, I think, macroeconomic dynamics could change, I don't think this is going to solve the US's trade deficit. And all this idea of, bringing jobs to the United States, again, I think it's, you can't just use a tariff to do the trick, right? I mean, all these things about Apple is promised to invest $500 billion in the next 4 years. I mean, Apple invested like $10 billion last year in capital expenditure and $31.4 billion in R&D. That's all they did, like $50 billion at the max. How much did they spend on stock buyback? $104 billion. I mean, it's not that the US does not have, the capital. We don't need whatever sovereign funds to invest. I mean, we just invest. We just need to invest. I think that's the key. I don't think it's China stealing the jobs. I think it's really this whole financialization, this whole idea of, shareholder maximization, that is what kills the jobs. And I think, Randy talked about exorbitant privilege this morning. I think with a country that does not have all these balance of payment constraints and the real resources constraint because the rest of the world are willing to have shiploads of products here, there's no reason why this country cannot create enough jobs, cannot feed everybody, right? 1 in 10 people in the US experienced hunger last year, 11.1% poverty rate. There's just no reason that things have to be like this, right? With all this $1 trillion of deficit, it means that the US is actually getting the real goods and services. So I think, again, first of all, I don't see this tariff can solve the trade imbalances. And second, I don't see the point from the US perspective. Why do you need to get rid of the surplus, the deficit, which is goods surplus?
Do you want to add to that? Because I noticed that in your slides, you showed that from 2017 to 21, the tariffs actually had no impact whatsoever on the bilateral or even the multilateral current account.
Yeah, I mean, there was a very small marginal impact, I would say, on, on the bilateral trade deficit with China. But I mean, again, there are more structural issues at hand here. I mean, mostly, the fact that you have, since the 90s, you have been structuring your value chain in a completely sort of, scatter sort of way, seizing also the opportunity to build around, your alliance in, say, in China, in Mexico, in other places. And then all of a sudden you flip this, this switch button or the off button using tariffs, say, then the tariffs will do the trick. I mean, it's totally nonsensical, especially if one thinks, the policy, applying, try to go, I mean, it's even more nonsensical if one thinks, that these policies apply widely across, all the major partners of US. Say, if you were to kind of, hit China, I could still understand. I could see the point. Perhaps this is not the best tool, but still, you can. I mean, I can see a reason why, why to use tariffs, like just for that, just to hit that specific country. But then Mexico. So some of those, you started, you as US, you started part of this process of moving your production chain back via using this friendly shoring or reshoring sort of policy, and moving back to Mexico because you thought, well, I mean, it was de-risking, and then it was, but we were seizing also this kind of offshoring strategy that can allow us to sort of maintain some of this trade relationship, and then all of a sudden, then you impose the tariff also on this other country. So it's just, I mean, come on, it's closest to a joke that I can think of. So, and again, I mean, it's if you start crunching the data like we started with this policy node, you really start to think, it's actually arising a number of interesting patterns, such as, for instance, I mean, I did mention the figures for the 43% of US trade being a related party, so intra-firm trade. So actually, for imports, the figure even increases to 50%. That is, 50% of US imports are imports between between companies that have some kind of ties and relationship between the sort of US and whatever other countries that are engaging this kind of this kind of import. So obviously the rules of trade in terms of, okay, so we are competing against a Chinese manufacturing BID or something. No, it's it's actually, I don't know, in imports of Walmart Mexico with trading with Walmart US. So it's way more complicated. So it's and again, so who are hurting? Who are hurting in the end? You are hurting yourself because you're your own companies, and that's why there's been, in my opinion, this pushback and in terms of resistance, also in terms of more in sort of. Companies, and then those companies that have supported the Trump re-election campaigning. So yeah, I mean that's my view on that.
Ndongo, you wanted to say something, and we're running out of time, so one more question after this as well.
Okay,
just to add that the discussion on trade deficits in the US is seriously misguided, as you know, the discussion on the perceived role of taxes. And this is misguided for at least two reasons. Most people think that we are still in a system of international gold standard or gold exchange standard. Because what happened during that period, let's say in the early 1960s, when France under de Gaulle had, trade surpluses vis-à-vis the US dollar, de Gaulle would aggressively go to the Fed to say, oh, I don't want US dollar, give me my monetary gold. That's no longer the case, you see. Now the type of deficits that the US enjoys since the end of this system of international gold standard is what the French economist Jacques Rueff used to call deficit without tears. In the case of the US, the US dollar do not leave the US payment system. That's not the case of other countries. So countries enjoying, trade surpluses vis-à-vis the US transfer net goods to the US, you see. So maybe the question could be, trade liberalization had gone too far, maybe you don't have this or that industry, and maybe people could talk about that. But generally speaking, the discussion about trade deficits, it's always, misguided, even in the context of developing countries.
Thank you. All right, I think that is, one more question. Let's do one more. How about you over here on the side?
So question on the Global South. So when it comes to the nations in the Global South, would it be a fair assessment to say that even the ones that have foreign debt, as long as they can issue their own currency, they can start to build the things that they want to build in the regards to infrastructure, and for the ones that are using foreign currency, they should just stop doing that and begin to issue their own currency so they can do that?
It's more complicated than that, but you're roughly correct. But the devil is in the detail. So you have to, every country has some fiscal policy space that they can tap into as a sovereign issuer of a currency. But if you don't spend strategically to start targeting your inflation pressure points, which in the case of developing countries in general is food imports, it's fuel imports, it's high-tech imports. If you don't start building resilience in those areas and you're spending somewhere else, then you're feeding those inflation pressure points and they're gonna come back to bite you, and then your external constraint is gonna force you to give up. Or your people are gonna rise up against you because you're not able to handle inflation, you're not able to handle anything. So you have to spend strategically in those areas first, the building blocks of development. And the international architecture is not designed to allow you to invest in those priorities. Because an investor that's giving you dollars to invest, say, in renewables, they want you to generate dollars, which means the renewable infrastructure you're building is not gonna be for your people. It has to be for exports, either exporting green electricity or green hydrogen, or exporting from a green industrial zone, which means you're always neglecting the building blocks of your development. So to break that cycle, you have to prioritize your agriculture, your food sovereignty, your energy sovereignty, so that you can get out of those structural debt traps. And that's the problem with a lot of countries in the Global South, even those who hear vaguely about MMT, oh, yes, we're sovereign and everything, and they start shooting themselves in the foot because they actually never read the details about the MMT literature, about how you actually strategically, over time, build a higher degree of economic and monetary sovereignty. They think that monetary sovereignty is something that you declare by decree when the prime minister makes a speech. It's actually something you acquire with strategic investments.
All right, we'll stop there, and thank you very much. Give a big round of applause.